Yeah, hi Deepak, hi everyone. Good evening.
Good evening, Arjun.
So we are recording this call. Also, we are live streaming it on YouTube. We have 13 participants. We will wait for 2 minutes and then we'll start.
Sure.
Deepak, we have 15 participants. Maybe we can start slowly. People will join.
Okay. Good evening, everyone. So today I'll be talking about the monthly market update on for the month of April. So disclaimer. So it's not kind of any recommendations of any stock or anything. So we're not recommending any kind of. So request everybody to seek their own personal advisors before making any investment calls. Let's start off with the performance recap of our funds. So looking at the pure equity funds, the flexi cap, we had a bit of underperformance in the last 3 months period, but actually we have started recovering from there. The last 1 month and as well as in the last 15 days, we were in the sixth position as well as in the 15th position, the Q2 performance, quartile two ranking. So we have just started improving on the performance front. And then, however, the markets have turned volatile right now. So there's a bit of underperformance also coming in the recent last 2 days. Similar with the tax saving fund, we continue to have alpha there. We have been beating the benchmark at 1.21% in the 15 days and as well as the 1 month period by 0.58%. The 6 month and 9 month, we are having an outperformance of 2.26 and 2.69%. And we continues to be in kind of the quartile two performance there in the ELSS fund. Whereas in case of aggressive hybrid, for the 6 month and 9 month period, we are kind of having 22% kind of a return with an outperformance of 6% and 4.95%. We are also beating the category average by 2.51 and 3.39%. We are in the top quartile ranking there. In the 3 month period as well, we are in the Q2 and with an outperformance of 0.48% over the category average and 1.63% over the benchmark. In the recent past also, we have continued to deliver alpha there in the aggressive hybrid. And we are in the quartile one ranking there in the 15 days and 1 month period, we are in the quartile two. Whereas we look at the balance advantage fund, we continues to be in Q1, except for the 1 month period, we have been kind of slipped to Q3. We still have alpha there. We are beating the benchmark by 1.16%, but however, we have been marginally down against the category average in the 1 month period. But having looked at that, the 3 months, 6 months, and 9 months, we continue to outperform. In fact, the 1 year period also, we are in the Q1 there, and as well as the 3 year, we have moved to Q2 now. So earlier in the August 2023, if you go back to August 2023 and check the performance of these funds, we were all in Q4 and across all the funds. Now, over the period of the last 8 months, we have been implementing the EQI strategy or the quantamental strategy. Ever since we implemented that, We have moved to Q1 across all the fund, and the strategy is implemented across all the schemes. So all the schemes are moved to Q1 and Q2 consistently. And we have been in the top quarter performing funds across all the fund categories, basically. Similarly, in the multi-asset allocation fund, we have been having consistent alpha over the benchmark and also beating the category average in 6 months period. But however, the 1 month and 3 month we have been marginally underperforming in against the category average. Now, in this fund, we are comparing ourselves with the debt from an equity taxation perspective. The debt taxation is not being considered here. If we add the debt taxation funds as well, so we'll be outperforming them, and our performance will be much improved there, and we'll be moving into Q1 and Q2 there against the entire multi-asset category schemes. So that's the update on the fund performance. To just a recap of what happened in the last month, all the indices made lifetime high, especially the Nifty mid-cap index and as well as small cap index made a 52-week high in the month of April. Post the kind of underperformance in the month of March, where we saw a huge amount of selling pressure due to SEBI's liquidity concerns. So we saw kind of selling pressure coming in the mid cap and small cap especially. And even the large caps had yielded to the pressure due to the FI outflows. We saw all the three indices coming back quite strongly. The large cap, mid and small cap coming back very strong. And even the bank Nifty, which was consolidating in the last few weeks, have just started kind of moving back and also made 52-week high in the last 1 week now. After the fourth quarter results have been reported, the earnings have been quite stable there, and then that has actually pushed the bank Nifty to 52-week high as well. And from a macroeconomic perspective, we are seeing a steady performance on the PMI. We're also seeing the GST collection being robust, and the GDP at 7%. So the pegged at 7% by the Asian Development Bank. So that's one thing which makes India stand alone basically against the entire globe. So we are growing at 7%, where the entire globe is trying to struggle to grow at even 2.5 to 3% to make a 2.5 to 3% kind of a growth rate. So that makes India something unique at this kind of a junction. And hence the equity risk premium also kind of commanded by India to a large extent compared to the global markets or BPS. Now looking at the other global markets, so US, we have seen the kind of PMI, the economy is kind of getting into some kind of constraints as of now. We are seeing kind of the slowdown in the US economy as of now. The GDP came in at 1.6% last week. We saw the PMI contracting to 49 levels. This is the first time after close to 2022 levels. So after that levels, after post-COVID, we are seeing the PMI contracting now below 50 levels in the US. This is because of the high interest rates and obviously the slowdown in the manufacturing activity happening in the US. The job markets initially it is the early days for the job cuts that we are seeing in the US market. So we would expect the job cuts to be more going ahead because of the high interest rate cost and the slowdown in the economy. So we would see more job cuts coming in. That would impact the demand side of the inflation. Inflation as of now is still sticky. We saw the inflation numbers coming at 3.5% in the last month. So that would remain kind of a bit more sticky in the medium term. So we cannot expect any interest rate to come down in the near term future because of this. So we are seeing kind of the inflation, especially more to do with the supply side constraints, the supply side disruption because of the Red Sea crisis, because of the Israel and the Gaza Strip, the war between Israel and the Gaza Strip, basically. And also the Houthis are attacking the ship movement in the Red Sea. That's impacting the supply side of the inflation, basically. So the global inflation is also going to remain sticky for some more time. And we are going to see more and more pressure on the disruption or supply disruption also coming in because of this. Until this geopolitical factor slows down a bit and the ceasefire comes into effect, we are not going to see the inflation coming down immediately. Now, only the demand side destruction will bring down the inflation. We are going to see the kind of supply side pressure to be up on the inflation front. And because of this, the crude is also gone up to $85 to $87 in the last month. And more importantly, because of this inflation remaining sticky, US Fed has actually decided to postpone the interest rate cut, which was actually as expected in our previous meeting as well. We have always been vocally advocating people that interest rate cut will be delayed. So as of now, we are expecting we're not expecting any rate cuts in this calendar year. So earlier we were expecting one rate cut in the last quarter of this calendar year, but now I think we need to postpone it to the first quarter of the next calendar year because of this prevailing inflation conditions and then kind of the economic slowdown, which is going to take a bit more time for US to actually see kind of the QT to taper off. So the quantitative termination in US would take some more time for the US to taper the QT. So that's the condition on the US front. Now on the other side, on the European market as well, we are going to see kind of delay in the interest rate cuts. We're not going to see any major cuts. Swiss bank was the first to cut interest rate in the last month, but now the European Central Bank is going to delay the interest rate cut there as well. We saw the Deutsche Bank raising the GDP forecast of Germany to 0.3%. The previous forecast was at 0.2%. They've actually increased the forecast. So that means to say the GDP growth is still robust there. But having said that, the pressure is still there on the inflation front. So the European Central Bank will not be in a hurry to cut interest rate because the GDP is still resilient relatively. And the jobs market is also not very kind of getting impacted on the international level. So that's the reason we are not going to see any immediate impact of the rate cuts coming in there, even in the European Central Bank as well. Japan, on the other hand, we saw a few months back, they hiked the interest rates to 0.1%. Now they are facing the inflation pressure now. So they would like to hike the interest rate and then they would like to strengthen the yen as well. So that's the reason they actually increased the interest rates to 0.1%. So yen continue to weaken against US dollar. That is impacting the Japanese market, and the export markets are still resilient in the Japan relatively. China is going through kind of monetary easing as of now. We saw the industrial production profits rising to 4.3%. So that's actually kind of marginally, it was slower than 10.2% rise in the first 2 months of the year, basically. So kind of we are seeing a bit of slowdown, but the monetary policy is getting eased. They're making a liberal monetary policy so that to boost the economy right now. But having said that, China is accumulating the raw materials, especially the natural resources, quite significantly now. It might be because of the geopolitical factor or something planned by China in the future. We have to wait and watch what China is trying to do there. But we are seeing some kind of marginal inflows coming back to China because of from the FIIs, the foreign portfolio investors. So that's early days of FPI flows going back to China. So it's kind of bottomed out. The slowdown has kind of bottomed out. So that's the expectation from most FPIs who are parking money in China as of now. They're looking at a contrarian view on the Chinese market relatively. So that's where some of the FPIs are kind of buying into Chinese market as well. But having said that, given the economic dispersion between India and China, India is still a preferable market over the Chinese market in the relative terms. So on the global factors, we have seen the metal prices and the commodity prices actually kind of going up. And especially gold as a commodity, we saw gold rising because of the central banks buying into the gold. China has been kind of a major buyer of gold in the central bank in the global markets. So the reserves, the gold reserves in China is going up because they need to move away from the dollar reserves and try to strengthen the currency. So they're just buying the gold as well. And we are also seeing some of the emerging economies also buying into some of the African countries and some other emerging economic countries buying into gold as well at this juncture because to strengthen their currency against the yen. So gold is something that most economic countries, the emerging economies are looking at to buy. Now, talking about markets, on the US dollar term returns, we saw India kind of outperforming in the last 1 year period. So after that, we have US and Japan, the leading markets. In the last 1 month period as well, we saw China kind of getting a boost again over the India and other emerging economies. So we saw Chinese market getting because of the stronger FPI flows. In the 3 month period also, we saw the Chinese flows have been actually increasing. So that's the reason we saw the kind of buying back the stronger equity market performance in Chinese and in the 3 month period and 1 month period. But actually saying that it's kind of early days because we are seeing mature volatility happening in the global emerging markets and as well as in India to a large extent. So this volatility is actually seeing outflow from India to a large extent. But the DI flows have been quite strong in India. So that's actually pushing the markets in India. So in the last month, in the month of April, we saw Nifty gaining 1.2% and the small cap index gained by 11.4% and mid cap was up by 4.7%. After the month of March, where SEBI actually kind of intervened on the liquidity factor, where SEBI kind of questioned or the regulator questioned on the liquidity of the mutual funds, we saw kind of sell-off coming in the mid caps and small caps. Now that entire phase got reversed in the month of April. We saw the small cap bouncing back by 11.4%. Mid cap was up by 4.7%. For the entire year, if you look at it in the last 1 year, we have seen the small caps rallying by 74%, whereas the mid cap is up by 56% and large cap by 24%. From a valuation perspective, large cap is fairly valued at trading at 2 times standard deviation, whereas mid and small cap is still expensive. They're trading more than 2 times standard deviation. The current earnings has to be factored into this valuation. When once we factor into this valuation, the current earnings into the valuation will relatively look at 2 times standard deviation for the mid and small cap. So the charts here indicate that the large cap is trading much below 2 times standard, marginally below 2 times standard deviation, but whereas mid cap and small cap are trading above 2 times standard deviation. Kind of a spike in the valuation for the mid caps and small caps above the 2 times standard deviation. So kind of marginally expensive for the mid caps and small caps. And talking about sectors, metals kind of continue to outperform the broader markets. We saw kind of real estate also coming back strongly in the month of April. And as well as the other sectors like a public sector company continue to outperform in the month of April, and consumer durables also gained marginally by 7%. Especially the air conditioning manufacturing companies and FMEG companies actually performed better in the consumer durable space the last month. IT continued to underperform. We saw kind of underperformance from IT, and as well as the pharma sector has been kind of underperforming in the last 1 month. So there's been kind of pressure on the both IT and as well as pharma sectors. Pharma, it's got to do with the US FDA intervention in some of the companies. That has actually impacted the performance of certain pharma names as well. IT as a whole, we saw the earnings have actually kind of being kind of surprise factor there on the earnings front, especially on the negative side. The deal wins have been kind of under the weather. So it's kind of, that's the reason we are seeing kind of pressure on the IT companies as well. So that would continue for some more time. We're not going to see any kind of revival in the IT index immediately. So we'll have to wait and watch till the economy, broader major economies to recover, especially in the US and as well as Eurozone. That would give a kicker for the IT companies to see the IT spending to come back in a bigger way. And that would lead for the IT index to rally. More importantly, we are seeing consistent job cuts happening in the top 4 IT companies in the last 3 months. So that itself is an indication of a major slowdown coming in the IT index, basically. Now, talking about individual sectors, consumer durables, we saw some kind of spike in the demand, especially due to the extended heat wave across the country. Especially the AC sales have gone up, and companies which are favoring that have actually outperformed the broader markets. So we have to be stock specific. We are stock specific here and adding certain companies in that name. Oil and gas, the sector has been quite expensive. So because the oil is trading at above $85, we are being kind of cautious, and we are looking at the upstream companies more. We are confident of the upstream companies, and we're also selectively adding the downstream companies as well. On the auto sector, the demand from the electric vehicles continue to remain strong. So we remain overweight on that space. But having said that, it's kind of overbought as of now. The valuations have been expensive. We have also been booking profit here. Though we are overweight, we have been booking profit. We are trimming our exposures marginally, and then we are kind of stock specific exposure. We do continue to maintain a stock specific exposure here in the auto space. FMCG, we continue to remain underweight because the sales are being kind of under the weather. So kind of most companies are kind of reporting lesser sales because of the slower rural demand. So kind of that's impacting the sales to a large extent. Even the urban consumption is not actually kind of filling the bucket for the FMCG companies. So that's where we are seeing kind of slowdown happening on the FMCG sales. The margins are also a bit under pressure for certain companies. So we are being kind of cautious on certain FMCG space. So we continue to remain underweight here. Though in a kind of crisis situation, FMCG companies tend to outperform as a defensive bet, but it's not a structural story there for FMCG companies to re-rate from here on. And given the excessive heat wave across the country, the rural demand is going to be kind of muted. So we expect to remain underweight on the FMCG companies. On the banks, we are seeing kind of pressure coming on the NIM right now. So it's going to remain under a range. The NIMs are going to remain in a range. And as well as the CASA is going to be under pressure. So that's been there in this quarter. So the next quarter, we can see the CASA improving marginally. But having said that, most banks are kind of focused on improving their deposits as of now because the credit to deposit ratio is a bit skewed towards the credit side. So they have to mop up more deposits. That means to say the margins will be a bit impacted. So we'll continue to remain selectively bottom up on certain counters, but overall we prefer with some of the PSU names. But after the recent RBI notification on the provisioning norms for the project-related kind of exposure, so we'll have to be cautious on that. But it's actually kind of impacted the valuation to a certain extent. I think it's kind of behind us now, so we are not going to see any major impact coming from that. There'll be a marginal correction on the valuation front, so that's got adjusted in the last 2 days of correction that's happened in the markets as of now. So we continue to remain bottom up here. So we like some of the frontline private sector companies and as well as few frontline public sector companies as well. Metals, we continue to remain overweight on the metal counters because of the extensive commodity cycle playing out. And this is the early days of the commodity cycle playing out. We expect the commodity cycle to play out much stronger. So with China marginally increasing kind of their kind of buying capacities, their inventory levels are shooting up in China. So that's the reason we are seeing kind of metal prices remaining strong. So we continue to remain kind of selectively bottom up on that, and we continue to remain kind of overweight on the metal sector. From a valuation perspective, it's trading at 2 times standard deviation. Though the valuation is kind of fairly valued as of now, we continue to remain kind of overweight on the sector. Public sector companies are being kind of quite expensive. We have been booking profits here, but having said that, our conviction has been strong on the power, defense, and railways. These are the three major themes that we continue to remain positive, especially within the power, the rural the renewable energies are the ones which we are kind of very bullish upon. That's where the government focus is upon as of now. Post-election, we expect the BJP government to come back to power. That's the fund house expectation. So we expect the fund house, the BJP government to come back to power, and the policy stance is going to continue to support these sectors. So that's the reason we have a high conviction on this sector. So we kind of overweight on this sectors as well. On the IT, we continue to remain underweight. We are going to watch for the economy to improve and how the IT spending is going to come back on a bigger way. So that would take some more time to happen. So we continue to remain underweight on the IT. Similarly, pharma and chemicals, we continue to remain underweight. We are seeing more incremental kind of pressure coming from the US side, especially from the US FDA front. So we continue to remain cautious on the pharma and as well as chemical space. So the sectors are being kind of underperforming because of that. Chemicals, the inventory has been behind us. The inventory destocking is happened at most of the companies. It's fairly valued as of now. The spreads started stabilizing in between, but having said that, there's a long way for the sector to re-rate. So we have to see the demand coming in a bigger way for the volumes to pick up. So we have been watchful about this sector, but this can be a kind of contradictory contra bets as of now. So we continue to remain underweight, but we are watching this sector pretty closely. Now moving ahead, talking about the bond yields to earning yields. So we are seeing the bond yields remaining stable. That's actually favoring the bond markets as of now. As we go closer to the rate cuts, so that we can see some kind of rally coming in the bond market. So we are seeing the yield stabilizing around 7.19% and the US bond yield rising up to 4.7%. And marginally, we saw kind of correction in the yields happening to 4.6%. So it's kind of stabilized around 4.6% for the US and 7.19 to 7.2% in case of Indian market. So the yield is stable around that. So the bond markets are looking relatively attractive as of now for the 2 years to 3 years terms. We are seeing kind of DIs continue to participate quite strongly in the Indian market. That's what is keeping the markets elevated and kind of on the positive side. The FIs have been net sellers. In fact, we saw almost 9,000 crores of outflows from the FPIs. In the month of May as well, we have been seeing consistent outflow coming from the FPIs. The foreign portfolio investors have turned negative net sellers in Indian markets. The DIs or the domestic institutional investors continue to bind into the selling pressure as of now. So that's kind of helping the DIs to buy stocks at a better price and average out the portfolios to a large extent. Talking about the global update, the inflation inched up to 3.5% in the month of March. It was above the expectation and as well as kind of was a key dampener for the delay in interest rate cut. This is going to persist for some more time. So US officially we can officially tell that they're in a phase of stagflation. I'll be talking about in a subsequent slide. European Union also, we are seeing kind of the inflation remaining sticky at 2.4%. It would take time for US for the inflation to come down to 2%, which is the expectation for US Fed to take any call on the interest rate cycle as of now. But the demand side is getting disrupted. The supply side construction is still prevailing, but the demand is slowly kind of coming off. So it's early days, but it will take some time for the demand to kind of see a major impact on the inflation. So first data that we are seeing is the GDP slowdown in the US. We are seeing early days of job cuts happening. And the third thing is the PMI is coming off below 50 levels. These are the early indication of the slowdown in the US. That means to say the demand is going to distract it. The purchasing power is going to go down a bit. With the job cuts coming in, more and more people will try to kind of delay any purchases. That means to say the inflation over a period of time will come down. The core inflation, which is stronger right now, so eventually it has to come down. And with crude price still being high, the energy cost is the one which is kind of impacting the inflation quite a bit. So any kind of ceasefire coming in the Middle East, that will gain immediate push to the kind of bring down the crude prices. That will have an immediate impact on the inflation, especially the core inflation going ahead. The same story with the European Union as well. The energy cost is the one which is impacting the majority of the inflation as of now, and the core inflation has also been strong. The food inflation has been quite stable. We're not seeing any major increase in the food inflation, despite the supplies are getting disrupted and the traffic to the Red Sea is getting disrupted. The food side inflation is not seeing a major impact as of now. So that would continue for some more time. We're not going to see a major impact coming from the food side, from the food commodities, but the energy cost is still on the higher side. Similar story with UK. Japan, on the other side, we are seeing kind of mixed inflation numbers coming in. We saw almost 2.8% in the month of February and in March at 2.7%. With the hike in interest rate, we are seeing kind of slowdown in the inflation happening in the Japanese market. So it's early days as of now. We would see the inflation dropping down below 2.5% in the medium term in Japanese market. So US officially, we are seeing the GDP kind of slowing down, but the inflation is remaining sticky. So it's the kind of a typical recipe of a stagflation happening. So it's the early days of the inflation remaining strong, whereas the inflation kind of remaining sticky in the medium term, the GDP coming down, coming up. So that's the phase of when we call the stagflation coming in. So this is a place where we see kind of we get to hear more of the negative news on the economic side. We are going to see more job cuts coming in the US. We are going to see the GDP numbers going to be slowed down going ahead. We are going to see the PMI numbers going to be under stress. So these are the negative news that would come out more from the US side. That would put pressure on the US Fed not to hike. Definitely a rate hike is totally ruled out as per the recent Fed meeting. But the rate cut, which is going to be delayed, if there's a cut in the crude prices or the energy costs, that would bring down the inflation quite a bit immediately. So that would actually force the US Fed to rethink on the delay in the rate cut. So we'll have to wait and watch if the ceasefire in the Middle East actually play out. So, which is very unlikely to happen right now, but over a period of time, with the demand going slow down, the inflation will come down. So, as of now, we are not expecting any rate cuts to happen in this calendar year. We are postponing our decision of the expectation of rate cut to happen in the first quarter of next calendar year. So the rates will be kept unchanged. We are not expecting any rate cuts happening. So most central banks across the globe are going to keep the rates unchanged, except for China. They might see some kind of rate cuts coming in from China further to boost the economy as well. More importantly, why US cannot hike interest rate is because they are sitting on a huge pile of debt. This debt is going to increase to $50 trillion by 2030 or 2034. So that means to say majority of the papers which are maturing next year, they have to be serviced at a higher interest rate because of the higher repo rate that's been prevailing in the US market. So that would be putting a pressure on the US FDA, sorry, US Fed to make sure they can't keep this for long. They'll be forced to cut interest rates. So they can't delay the interest rate cut also for longer term. So that will make actually kind of revise their actually forecast on the inflation as well. So the current expectation is 2%. They might move it to 2.25% as well if required before they actually do the interest rate cut. So though US Fed has given a clarity that there's no political pressure on them because of the elections coming in the US, it's more of inflation that's coming out. But the economy kind of deteriorating, they might be under pressure and to curtail on the the debt side, the servicing cost on the debt, they might even rethink on the interest rate going ahead, and it might happen over the say 5 to 6 months down the line. That means we are talking of the fag end of the year or the early quarter of next year for the rate cuts to come in from the US side. The yields have actually shot up. So we are seeing the yields going up to close to 4.7% or close to 5%. So the 2-year yield has actually shot up more than the 10-year yield. So we are being kind of, the short-term debt are being kind of under pressure as in the US. So we are seeing kind of, that would be a kind of more attractive market for some serial bond investors happening in the US. As of now, the short-term debts are looking more attractive there. On the domestic side, we are seeing the GST collection being robust. We saw 2.1 lakh crores of GST collection happening in the month of April. So this financial year, we are going to see the GST collection being more robust actually compared to 2024. So that means to say there's an indication that the revenue or the earnings of the companies are going to be strong. We're not going to see any major slowdown coming in the earnings. So the earnings is going to remain strong for majority of the company. There's actually a quasi indicator of the earnings remaining strong. And adding to this, the PMI has also been resilient, both service sector and as well as the manufacturing sector PMI has been resilient. We saw almost 61.7 in the case of service sector PMI and 58.8 for manufacturing. We might see a dip in the kind of manufacturing and service sector PMI in the month of April. Sorry, in the month of May. But that would be kind of that doesn't mean that the economy is in slowdown phase, but it's going to be a seasonal impact that's going to happen. So we might see some kind of dip in the PMI number going ahead. So, but having said that, the economy is still resilient. We expect this actually another indicator for the earnings to remain stronger. So this means to say kind of we can't expect any slowdown coming in the corporate earnings. That means to say the valuations or the equity markets are going to be robust, and we are not going to see a major correction coming in the equity markets from here on. So what's the outlook in place? So the inflation is going to moderate gradually. We're not going to see a dip in inflation happening in the immediate terms. So it's going to slow down over a period of time, and the demand side destruction is what is going to bring down the inflation on the global front. And relatively, the India side, it's going to be the inflation would gradually come down over a period of time. The energy cost is the one which is contributing majorly as of now for the inflation globally. So as the energy costs come down with the crude price coming down, so that would bring down the inflation. Now, if the crude price has to come down, it's going to be kind of there has to be a ceasefire coming in the Middle East. If that is going to delay, if the geopolitical factors are going to play out, then the supply side pressures will continue to remain. That means to say we'll have to wait for the demand side to slow down a bit before we see the inflation coming. Liquidity is quite adequate in India, so we're not seeing any kind of liquidity constraints coming in, and RBI is ensuring that they're maintaining just adequate liquidity. As I said, the interest rates are going to remain unchanged in this entire calendar year. We're not going to see any rate cuts coming in this calendar year. We can expect the rate cut coming in. We were earlier of the view that one rate cut were coming in the entire CY24. We're now postponing it to the first quarter of next calendar year. Bond markets are being kind of stable. We saw the yields at 4.7% and for the US and around 7.2% in case of India. That would remain stable. We're not going to see kind of major rally in the bond markets, though India's weightage in the bond indices have gone up. Though the flows are coming in, the borrowing calendar is also going to be announced as when the new government is coming. So that would actually kind of keep the yields kind of under pressure. So the yields will remain at 7.2% or in the range to 7 to 7.2%. We're not going to see moderation in the yield below 7% immediately. Equity markets, we saw kind of the weightage of India going up and getting increased in India, the emerging markets index of MSCI and the FTSE. But having said that, the FPIs have been net sellers in India. That's because of the liquidity constraints happening there and the delay in the kind of the interest rate cut. So the FPIs have been net sellers in India. So it would take more time for the FPIs to return back to Indian market. So the DIs are the ones which are keeping the markets afloat. So we're not going to see any major correction coming in the equity markets. The markets are going to remain volatile in the shorter term. We are going to see some kind of selling pressure in the medium and short term. But having said that, we're now going to see below 21,800 or 900 levels. So that would be an immediate support for the major support for the equity markets as of now. We might see 20,000 is another emotional support for the Nifty as of now, and 21,800 is kind of the medium-term support that we are looking at. So further selling pressure below that would be kind of we will be entering kind of seeing more pressure coming in, but I don't expect that to happen. We are going to see some kind of buying back coming into the equity markets as well. Uh, we are looking at opportunities whenever there's a dips in the markets. We are seeing the DIs coming and buying back into the markets as well. So we're not going to see a major dip in the equities, but having said that, we are not going to, the upside is also capped. We are going to see it's a range bound market, it's a sideways market. So we are seeing a time correction happening in the equities. And if I have to put a number, if you look at the top 20 quality names, they're not even better FD returns. So having said that, some of the returns have come only from the mid caps and small caps to a large extent. So that's where kind of we are kind of positioned more towards the mid cap and small caps in the flexi caps as of now. So that's the update on the broader markets. And on the key risk, what are the key risks for the markets as of now? Any short-term spike in inflation, that because of the spike in the crude prices or kind of the increased geopolitical conditions or the factors. These are the two major risks as of now for the markets that will have a kind of downward pressure on the equity markets as well. Any unexpected outcome from the election results. As of now, we are expecting BJP government to come back to power. If there's any kind of change in the outcome of this, the BJP government not getting the right kind of majority, so that will be detrimental to the market. The markets doesn't like any uncertainty, and they don't want any kind of, the market doesn't want any kind of hunger assembly to come into power. They need a clarity on the mandate for any kind of party to be kind of ruling, and so that the the ruling party has got a clear mandate to pass in the reform. That's what the equity markets expect. Any unexpected outcome will be kind of negative for the markets. We are seeing the new commodity cycle to play out. So that means to say most companies have to take the price hikes or their margins will be under pressure. They'll have to they have to live with lower margins. That means to say the earnings will be under pressure. So most companies will be taking a price hike. That means to say over a period of time, we might see the kind of slowdown happening in the sales over the next 2 to 3 quarters. So that would be something that we'll have to wait for the next 2 to 3 quarters to see how the sales prevail over the period of time. So it's early days of the commodity cycle to play out. So it's a long way for the commodity cycle to play out in the near term. So we are not seeing any kind of major impact seen from on the inflation front because of this. But having said that, most auto companies and many of these companies will be taking a price hikes on their products to make sure their margins are intact, their earnings are intact. So that's the update on market. We'll be more than happy to answer any specific questions from anyone. So.
If you have any question, you can unmute yourself and ask. Also, you can type in a chat box. So Deepak, we got one question in YouTube chat. So how UK model is helping us?
how EQI model is helping us. Okay. So EQI basically is a quantamental strategy. So where we are looking at both quant and as well as fundamental. So quant is the input for our fundamental analysis. So within quants, we are looking at momentum, volatility, and valuation as a three-factor model. And in the fundamentals, we screen the quality of the company before we take it into the portfolio. So now the quant models help us to rank the companies, the ones which are in momentum, which has got less volatility and still relatively cheaper compared to the broader markets. So we look at this number of companies which have got all the three characteristics, which are less volatile, momentum, and as well as relatively cheaper. When once we have the stocks in the descending order, so kind of the stocks with the rank on the descending order. So that means the stocks which are coming on the top, these are the ones which we take it into fundamental analysis, analyze why they are kind of coming and behaving in the way they are. What are the factors that are driving the momentum in the stock? It might be the earnings re-rating happening in the company. It can be the government reforms or kind of the order books, strong order books coming in the company. Some of these are names that we look at specifically. And we have our own conviction on the sectors where things are turning positive and where the government focus is all about. So we kind of write those kind of trends and then add these stocks into the portfolio. So it's a view of both quant as well as fundamental. And this enables us to kind of identify the right kind of winners into the portfolio. And yes, the markets kind of have its own kind of cycle. The market cycles are prevailing. But having said that, this actually helps us to navigate the kind of volatility in the medium term to shorter term. And it helps us to pick the winners against the majority of the losers in the market. So that's help us to make the winning portfolio and sustainably deliver alpha in the medium term to longer term. So the model might underperform in 1 or 2 months, but that's still okay. But in the longer term, what we are seeing in the media, in the 3 months to 6 months or more than that, we can constantly see kind of outperformance coming from the model. There's always a mean reversion happening in the market. So the model will help kind of go through a phase of underperformance when the mean reversion happens and then relearns. The model actually relearns how the markets are kind of behaving and accordingly change the kind of the momentum or the stocks kind of rebalances every month. So this rebalancing helps us to kind of weed out the stock which are mean reverting and identify the winners. And that's how we kind of build the stock portfolio over a period of time. So that actually helps us to kind of consistently build a winning portfolio.
Deepak, we have one question in chat box. This is small update about this market.
The US market as such is going through a bit of slowdown. We are in a stagflation mode there. So after the interest rate hike that happened from January or February of 2022, we have been kind of seeing the inflation coming down. And as of now, it's going to remain sticky. Right now, the inflation is at 3.5%. The US Fed is expecting the inflation to come down to 2% before they're going to cut the interest rate. Now, from 3.5% to 2%, there's a lot of changes that the economy is going to go through. Right now, if you look at the GDP growth, which was growing at 3.5%, has come down to 1.6%. There's a slowdown in the GDP growth in US. We are seeing the PMI coming down below 50. The early days of job cuts have been seen in the US markets. So what will this lead to is a demand destruction. So inflation is a question of supply and demand. So on the demand side, the demand will come down slowly, whereas on the supply side, it's going to remain resilient because the supply side is getting impacted because of the Red Sea crisis and the geopolitical conditions. So we're not so going to see any kind of impact coming on the supply side. There's no slowdown happening on the inflation is not going to see any kind of negative impact coming from the slowdown or from the geopolitical factors. In fact, that's going to prevail for some more time. So as the demand comes down, that's when the inflation will start easing it. So till such time, we're going to see a stagflation happening. So stagflation is a stable inflation, whereas the GDP is kind of going down. Your GDP growth will go down, whereas inflation will remain strong. It will be constant. So that's the phase where we call as stagflation. During this phase, what will happen is you will get to hear all the negative news in the US markets. You'll see the job cuts, the inflation going down, and as well as the GDP growth going down, the PM manufacturing activity going down. So these are some of the negative news that comes down, and there'll be defaults on the housing markets as well. So some of the early days, these are the early days, but over a period of time, if the stagflation continues, you might see some kind of defaults coming on from the housing markets also as well. So that will be more detrimental for the economy. So that would be like leading to a 2008 kind of a crisis if the interest rates remain elevated for longer term. So, but before that, we are going to see kind of people postponing their purchases. The PCE index, we track the index called the Personal Consumption and Expenditure Index. That's been resilient as of now. So that would see kind of a slowdown coming in, and that would be the indication that the inflation would go down over a period of time. As of now, the inflation is sticky. We need to see the inflation coming down, and over a period of time, that's when the interest rate cut will happen. So that would actually trigger the markets to on a positive side. So there's another question. If BJP loses this time, then how much it can impact the market and what is the strategy for the situation? It's a tough question to answer how much it's going to impact the stock markets, because if you look at the fair valuation, if you look at the PE of the stock market, it's trading at 20-21 times. Look at the long-term averages, it's around 12 to 14 times PE. So that means it's going to be a significant destruction in the capital, especially in the equity markets. But now, will the equity markets go down to that level? Possible. We can't rule out the equity markets going down to 14 PE levels or 15 PE levels if the BJP government loses in a big way. So that means to say there is no other single party which is coming with clear mandate. So if NDA doesn't get a clear mandate, and if neither the Indian alliance is also not getting a clear mandate, it's going to lead to an hung assembly. So that means to say there's uncertainty in the market, in the general economy. So that would be detrimental to the markets. So we can see at least 20% correction in the markets. So what would be our strategy? We'll have to hedge. We have to increase our cash position, hedge the portfolios. So we'll have to take hedging against each and every security that we have in the F&O space. Trim down our mid cap and large cap exposure to a large extent, especially move away from sectors like your PSU names, move into the private sector names which are more quality oriented, focus on more quality as a parameter. So our models will be changed to quality, low volatility, and as well as value at that point of time. We'll be sticking more towards the momentum, quality, and as well as value rather than picking up momentum. And over a period of time, we'll reevaluate the conditions and switch our models to the momentum then back again. So that would be the immediate action that we'll be taking if the BJP is going to lose the elections. Nowadays, YouTube, many people are promoting to buy gold and silver. Is this the good time for buying? The gold price have actually shot up in the last month. That's because most central banks are buying in the gold. That's the reason we are seeing the international gold price remaining strong. Our currency is also depreciating against US dollar. So the Indian gold price actually are remaining strong. It again depends on the individual's appetite, whether they want to buy gold and silver. But having said that, not necessary that the gold will continue to rally unless we are going to see more uncertainty come in the geopolitical factors. If more and more countries head for war and then the inflation stay increasing, then that's the time when the gold will become more lucrative. Otherwise, I don't expect the gold to rally significantly from here on. It can be in a range bound until unless the geopolitical factor increases and inflation increases. We're not going to see a major increase in the gold prices. Most countries are actually adding gold reserves, including China. So that's the reason you're seeing some kind of spike in the gold price in the immediate terms. But it's about uncertainty. If that continues and if the inflation goes up, that's when the gold will actually rally. Silver would actually underperform when the inflation increases because silver demand is coming more from the industry side rather than from the jewelry or kind of using it as a hedge against inflation. Silver is not the right kind of tool as an hedge against inflation. It's the gold which is more apt for kind of hedging the inflation to a larger extent. Now, silver would work when the broader economy is in a bull market. When we are seeing a bull market, that's the time to buy in silver. So we are anyway closer there, and we are getting the right kind of opportunities slowly. So we are just looking at opportunities to add a little bit of silver. So one can actually add a little bit of silver into diversify their portfolio, but not necessary that it would kind of be the right kind of strategy right now. Rumors is in the market that the bubble is going to crash and the Ashar Mehta scam, as there is huge manipulation in the stock price are going. Give some insights on this. There have been news around the Kolkata-based companies manipulating the balance sheets and the P&L. So we'll have to be. So that's where the quality and kind of screening the companies, knowing your companies pretty well is what matters. So that's what we as analysts, as fund managers, we do. That's what is our job, to analyze companies. So more and more companies which are manipulating, obviously those companies will get punished by the regulators accordingly. So it's better to stay away from unknown names, better to stick with the frontline names and then the large cap names and as well the mid cap and large cap and known small cap names rather than going behind every name which has been rallying in the market. So it has to be more focused on the quality front and would suggest investors to look at diversifying the portfolio by through the mutual fund route. That's a better way to invest rather than looking at stock specific news about the markets and kind of we're not going to see any major crash coming in because of this because it's not going to impact the broader markets in a big way. So Harshad Mehta scam was a bigger kind of sell-off happening in the markets. But now the liquidity situations is totally different. The industry participants are different. The market participants are different right now. So I don't see any major bubble coming in from because of this and a major crash coming in the markets like Ashar Mehta scam happened in 1992. So that wouldn't be the case in the markets as of. And our regulation is much more stronger than what you used to have in 1992. For lump sum investment, we need to suggest multi-asset allocation. Yes, multi-asset allocation is a better product to be positioned in a kind of the current situation because if any uncertainty increases, we already have a protection from the gold and that would actually help us to navigate through the kind of uncertainty. And obviously, the EQM model that we run in the multi-asset allocation fund, we're able to navigate the kind of volatility in the medium term to longer term. But it's short-term volatility is what we're not touching too much around, and we're not very bothered about short-term volatility because these are short-term phase, but we know that the markets are going to rebound in the shorter term. So we're not going to see a major crash coming in the markets as of now. So we have hedged our portfolio adequately. So we're not taking any deep hedging positions against every equity that we have owned in the portfolio. So we are kind of fair enough hedging position. We are okay with the kind of hedging position that we currently maintain, and we continue to remain bullish and constructive on the markets as of now. We are going to see the markets bouncing back as well because we're not going to see continuous selling pressure coming in the markets as well because we're not seeing any kind of economic stress coming in the broader economy. We're not seeing any major uncertainty coming in the global factors. There's nothing to bother about the global factors as of now. There's a delay in the interest rate cut. Barring that, we are not going to see the inflation spiking in a significant way. From 3.5% of inflation in US, we are not going to see the inflation going up to 5% or 6%. That's not going to happen in the US inflation as well. Having said that, the delay is not going to be very long. Whatever we are talking of July, August, that's been delayed to December or January of the calendar year. So 3 to 4 months delay in interest rate, which is quite fair in a longer term view. These cycles of broader economic cycles will play out like that. So the stagflation is going to continue for some more time. We're not going to see a major impact on the economy in a major way. These are short-term volatility that's prevailing in the market. So one should not be bothered about the short-term volatility. Yes, we have to be cautious, but it doesn't mean that you need to sell off your portfolio and then kind of prepare for some bad day. Not necessary. That's not going to happen in the markets. The markets are not going to knee crash from here. So we're not going to see a jaw crash happening in the market. So the markets are going to bounce back shortly. So it's going to be in a range. The markets are going to be in a range. We're not going to see a major dip in the markets. That's what my broader submission about the markets. Is it good decision to invest in the metal industry? So as of now, we are bullish on the metal cycle because the commodity cycle has started playing out, and then there's going to be a long-term story of the metal cycle. It's a cyclical industry. One needs to be very careful about this. When the dollar reverses, the dollar strength reverses. That's when the metal cycle will play out even much more stronger. And if China comes back in a bigger way because of the monetary easing happening in China, the GDP growth in China kind of picks up and the industrial activity picks up in China, then the metal prices are going to rally further. So it's early days for the metal industry. So we are constructive and bullish about the metal sector. Any NFO plans? Yes, we have a couple of. We are working on few products, so we'll be announcing to the markets at appropriate times. It's early days, so we'll be announcing to the markets at appropriate times. Flexi cap has underperformed the benchmark over 3 years and 5-year period. What would be the broad-based strategy for the fund going forward to perform well? Yes, the past performance has been bad in the flexi cap. I totally agree about that. We have changed our investment philosophy because I've come into the mutual fund since last 1.5 years. And it took me first initial 6 months to develop a new framework. That's where we developed the EQS strategy. In the last 8 months, we have been implementing the EQS strategy across all the funds. So the performance has improved from Q4 to Q1 in the 1 year period. Obviously, yes, the 3 year and 5 year period would take some time to see kind of positive movements to happen. So we are convinced on the kind of investment strategy that we are invested in. So that would actually play out in the medium term to longer term. That would help in kind of correcting the underperformance in the medium term. So one needs to be patient because the current investment strategy will help us kind of navigate the underperformance in the longer term as well. So our EQI strategy is implemented from 1st of September. So whatever performance that we are seeing across the funds is because from the effect of the implementation of EQI strategy across all the schemes from 1st of September onwards. Can rupee be stronger in the upcoming years? Very difficult question to answer because Indian government wants rupee to weaken a bit because to boost the exports. Having said that, they don't want too much weakening of rupee as well because that would impact the imported inflation as well. So the central bank will maintain a balanced approach there. The central bank is going to maintain a balanced approach. So if any kind of weakness coming in the rupee, the central bank is going to intervene, obviously. But having said that, for the growth to persist, so it's kind of a trade-off between the import and exports and as well as the growth and maintaining the stable currency. So the central bank may expect this currency to remain stable. They don't want any kind of depreciation or appreciation significantly from here on the either side. So they would expect the rupee to remain in a range in the same similar range. So they don't want any major movements on either side of the rupee as well. Obviously, when there's an interest rate cut happening in US, that's when the dollar will weaken. And a similar time, you'll also see rate cut happening in the emerging economies as well. So that would actually be a zero-sum game at that point of time. The currency would remain relatively stable. So more flows are going to come into the emerging markets at that point of time. That would strengthen the currency a bit. So we'll have to see the FPI flows coming in and the interest rate cut to happen. Both the things will actually boost the emerging economic currencies to strengthen a bit. Tax treatment in a debt fund. We don't have any major debt funds in our schemes. As of now, I think I would suggest to refer to the tax this one, but it's against we have the uh, we don't have any debt funds as such except the overnight fund, which is like it's an overnight fund is a money market fund that we have. We the tax treatment would be around similar to 30% on, and you have the input credit also coming in for the tax as well. So the inflation adjustment can also be done there on the debt side. So I would suggest you please consider talking to a tax consultant on that.
Thank there is one more question, sir.
Any plan for child-oriented fund or retirement fund? Not right now, sir. We don't have any immediate plans right. Which sectors are looking attractive to medium to long term in terms of valuation apart from banking sector? Also, what is your view on power sector considering it has already jumped up? Obviously, yes, the public sector companies like your power, railways, and defense have actually run up a bit. So, but that's where the major government spending is happening. Unless there's a disruption in the election, basically, if the outcome of election is going to be bad, we are still constructive on these three sectors as of now. yes, the valuations are expected or stretched, so we'll have to be cautious on that note. But it's a long-term story. One needs to be have patience for the long-term view. Yes, they can be constructive on these sectors. Apart from this, the ancillary sector which are catering to this, like your infrastructure or for that matter, the capital goods, these are sectors one can look at. And on a contrarian view, if somebody wants to have a contrarian view, then they can look at IT or chemicals. So that's a contrarian view who have got patience for to view for wait for 2 or 3 years. They can look at those sectors. Do you have any other instruments apart from mutual fund? Not right now. So we don't have any other major instruments right now. There'll be announcements coming from the company side on other product launches. So that will be announced shortly. Since we are a listed company, I can't announce it at this forum. So please do wait for some announcements coming from the company side.
Thank you, Deepak. I think that's all. It was very insightful session. Thank you everybody for participating.
And thank you, everyone. Thanks for your time. So we'll connect again next month. Thank you.